Candlestick pattern is one of the most important concepts when it comes to profitable trading. But it is not surprising that most traders still don't know how to use them. The hardest thing about trading candlestick patterns are about finding patterns that really work. Because there are so many models. But the truth is there is more. 96% of these models actually don't work. Because I have tested them all throughout my transaction. However, I find that a handful of models work extremely well and has brought me a lot of profit. In this video, I will reveal the top 6 candlestick patterns has been proven to be effective, as well as everything you need to know about them. One more bonus I will reveal:
how to combine these patterns with price action
to find trades with high win rates. First, what is candle? Candlesticks are a simple way to view price history. Each candle represents a price move on the chart within a specific period of time. For example, if you are on 1-hour time frame, each candle represents 1-hour price history. If you are on daily time frame, each candle represents 1 day's price history. Each candle provides for pieces of information in the same time period. First is OP. That is the opening price for that period. EXT is the high level that shows the highest price achieved during that time. Then have low. It was the lowest price achieved during that time. And finally close, that is the closing price. There are 2 types of candles: green candle and red candle. A green candle formed way, the candle closes higher than the opening price. Shows that buyers are stronger than sellers. Likewise, the red candle forms when the closing price is lower. Opening price shows that the sellers are stronger than the buyers. A single candlestick consists of 2 parts. Candle wicks are also known as shadows and bodies. The end of the upper candle wick shows the high price achieved during that time, while the lower candle wick end shows lowest price achieved during that time. However, for the candle body, everything is a little different. On a green candlestick, the bottom of the candle body shows opening price for that period, and the top part shows the closing price. For red candle, it is the opposite. The top shows the opening price, and below shows the closing price. When looking at the chart, you will note that candle bodies come in many different shapes. Some have large bodies. Other candles have longer wicks on one side. And some have small bodies with short candle whiskers. Each of these shapes gives us price fluctuation information.
and understanding them is essential for action
of traders to analyze the market more accurately. The first type is candles with large body and small body. The candle body reveals a lot of strength of the buy and seller. For example, look at a large green candlestick. This type of candle shows the buy has the upper hand. This is because the opening price is lower. But because the buying pressure is too high and the selling side is weaker, the buyers were able to push the price up. There is not much resistance from the sellers. This is why candles close in this shape. similar to a red candle with a large body, shows that the seller has the upper hand. Open at higher level. But because the seller is stronger, they try to push the price down. With little buying resistance, price moves down sharply. Before the candle closes, a small body candle tells a different story. A green candle with a small body shows, although the buy side has control, but they do not dominate, because the seller also put up a lot of resistance. Lower opening price, and the buyers tried to push it up. But because the seller is almost as strong, so the price does not change much, and close near the opening price. This is why candlesticks have small body. Similar to a red candle with a small body, shows that the seller has control but not dominance. Opening price at a point above, and the seller pushed it down. However, due to lack of selling pressure or strong resistance from buyers, they can't push prices down. That is why the candle closes in this shape. The second type is the candle with large candle wicks. Candle wicks also provides us with valuable information about price action. For example, a candle with a long wick at the bottom indicates strong buying pressure. Long candle wick at the bottom shows the price must have dropped a lot at one time. However, before the candle closes, buyers are strong enough to push prices back up. This is why a long candle wick below indicates strong buying pressure. For the exact opposite, a candlestick with a long upper wick indicates strong selling pressure. This is due to the long candle wick above. Prices have gone up at some point, reach high level. However, before the candle closes, the sellers tried to reject this bullish move and push price down. This is why candle wicks are long. The above shows strong selling pressure. The third type is the candle with a small body and wick equal. If the candle has a small body and equal wicks, it indicates that there is no bear, which seller controls the price. This is because both parties, bear and seller, tried to push the price up and down during this time, but neither side prevailed. So the candle closes near the opening price. Understand the concepts of body and wicks is necessary when starting to learn about basic candlestick patterns. So keep them in mind when making transactions. Now, I will show you the top 6 candlestick patterns, which I find most effective. Number 1 is the engulfing model. The engulfing pattern is a candlestick pattern. It's made up of 2 candlesticks. The first candle is smaller, followed by a larger candle of a different color. The bottom line is, the second candle body needs to completely cover the first candle body. There are 2 types of immersion models. Bullish engulfing pattern, when the smaller candle is red and the larger candle is green. And bearish engulfing pattern, when the smaller candle is green and the larger candle is red. When seeing an engulfing pattern on a price level, it can signal a potential trend reversal. For example, if price is in a downtrend and a bullish engulfing pattern is formed. It could signal an upward reversal. Means prices may increase. This is because the pattern shows that buyers have become stronger. When you see a big green candle, push price higher than previous red candle. Indicates a possible reversal. The second candle is bigger, the greater the chance of price reversal. To trade in this form, should confirm other factors to support. For reversal. However, if you see a valid bullish engulfing pattern forming, you can join the positio when the big candle closes with your stop loss order at the bottom of the green candle wick. The same applies to downtrends. When a bearish engulfing pattern forms, it could signal a possible reversal. Like big red candle, shows that the seller is strong more than the buyers. If you spot a bearish engulfing pattern, you can enter the order at the time the candle closes with your stop loss order set at wick the tip of red candles. Sample number 2 is pin bar. Pin bar is a candlestick pattern. Is made up of only one candlestick, characterized by a large candle wick on one side and a small body. There are two types of pin bar patterns. A bullish pin bar is when the candle is green, with a longer wick at the bottom, and a bearish pin bar when the candle is red, with a longer candle wick on top. When you see a pin bar candle forming on the chart, this means that the original seller has taken control. Push prices down. But then the buyers walked in, reject that move, and push the price back up before the candle closes. This shows that while both sides are active, the buyers have finally become stronger. Some traders can place orders as soon as they see a bullish pin bar, but I prefer to wait for another green candle to form. Confirm trend. Once the trend is confirmed, you can hold the position after the candle closes and place a stop loss at the bottom of the pin bar. The same approach applies to bearish pin bars. If you see a bearish pin bar forming, this means that the original buyers has taken control and pushed the price up, but the seller eventually rejected the move and pushed the price down before the candle closes. You can wait for an additional red candle to form for further confirmation trend. You can look for selling opportunities with stop loss plays at the top. Wick candle pin bar. Switch to form number 3. It is a 3-bar continuation pattern. This sample includes 3 consecutive candles must form in sequence. The first candle must have a large body and larger than the second bar. Second candle is smaller. Candles have different colors and larger than half the size of the first candle body. The third candle should be another big candle. Closes higher than the second candle closes. There are 2 types of 3 bars continuation patterns. A bullish pattern has large first and third candlesticks, green with a small red candle in the middle. And a discount model has large first and third candlesticks, red with a small green candle in the middle. Whenever you see this pattern on the chart, it may indicate a continuation of the price trend. Current trend. For example, if price is in an uptrend and a bullish 3 bars continuation pattern is formed, it shows that prices may continue to rise. This could be a good opportunity to enter a buying position. If you miss the initial uptrend, with stop loss at the bottom of the second candle, opposite to the downtrend, 3 bar continuation pattern formed in the middle of a downtrend, it may suggest that the downtrend will continue. In this case, you can place an order after closing price of the third candle, with stop loss at the high of the second candle. Sample number 4. It is a 3 bar reversal pattern. This pattern consists of a series of 3 candles. The first candle is large with an almost full body. Second candle is smaller, has the same color as the first candle, and has a small body. The third candle is a big candle, whole body, has a different color than the first 2 candles. The size of the third candlestick affects the success rate of this model. If the third candle body is equal to or greater than the first candle, it shows a higher success rate and is considered a strong signal. If the third candle is smaller than the first candle, this shows a lower chance of success and is considered a weak signal. There are 2 types of 3 bars reversal patterns. 3 bar bullish reversal. The first 2 candles are red, and the third is green. And 3 bar bearish reversal. The first 2 candles are green, and the third is red. As the name suggests, whenever you see this pattern on the chart, it signals a possible reversal of the current trend. For example, in a downtrend, if you see a bullish 3 bars reversal pattern forming, it signals that the trend may reverse to the upside. With this transaction, you can enter a buy order at the closing price of the third candle and order stop loss at the low of the second candle. In case of bearish 3 bar reversal pattern, it is the opposite. In an uptrend, if this pattern appears, it signals that the trend may reverse downwards. In this case, you can enter a sell position at the closing price of the third candle, and stop loss is placed at the high of the second candle. Pattern 5 is a breakout candlestick pattern. This is a type of candlestick pattern. There are many small candles with small bodies forming, followed by a large body candle. This pattern shows that the price is stagnant for a while without clear direction until one party buys or sells. Push price up or down. In this setup, the small candle series is called consolidation candle, and the big candle is called the breakout candle. For this to be a valid model, there must be at least 3 consolidation candles. However, the candle is more of a consolidation. There is a higher chance of successful breakthrough. There are 2 types of breakthrough models. A bullish breakout pattern has green breakout candle and a bearish breakout pattern. Has red breakout candle. Note that for both bullish and bearish models, the color of the consolidation candle is not important. The important thing is that they are small in size. Whenever you see this setup on the chart, you will usually see price continue in the ratio breakout candle. Let's look at an example. Here the price forms a series of small candles before a big green candle appears. Bullish breakout pattern forming. This signals that the trend is likely to continue to increase. To trade this setup, you can place order when the breakout candle ends, with stop loss order at the opening price of the breakout candle. The same principle applies to the bearish breakout pattern. For example, if you see many small candles forming when price moves sideways, followed by a large red candle, this would count as a bearish breakout pattern. You can open a short position at breakout candle close with stop loss order placed at the opening price of the breakout candle. Pattern 6 is a contracting candlestick pattern. This is a candlestick pattern. Include at least 3 consecutive candles of the same color. Each candle is getting smaller, followed by a large candle of a different color. This pattern shows that the trend is gradually weakening as indicated by the shrinking candlesticks. Then a big candle appears confirming the reversal. The size of the fourth candlestick affects reversibility. Larger candles indicate stronger momentum. Increased reversibility. I recommend you look for a template where the fourth candle closes above the second candle. There are 2 types of contraction candlestick patterns. A bullish candlestick pattern. There are 3 red contraction candles, and the fourth candle is green. And a bearish candlestick pattern. There are 3 green shrinking candles, and the fourth candle is red. Whenever you see this pattern on the chart, it signals a possible reversal of the current trend. For example, if price is in a downtrend, and you spot 3 red candles in a row, each candle is smaller than the previous candle. This signals that previously, the downtrend is losing momentum. Then a big green candle formed. Shows that buyers are currently dominant, and signals a potential reversal to the upside. If you see the setup on the chart, you can enter a position when the green candle closes, with stop loss at the low of the previous candle. The same principle applies to the bearish model. For example, if price is in an uptrend, and you notice 3 green candles are getting smaller, this shows that the uptrend is weakening. Then a big red candle formed. Ideally closed below the second candle. Indicates that the seller is currently in control, and confirm the reversal in the negative direction. In this case, you can enter a short position when the red candle closes, with stop loss at the high of the previous candle. Now keep this in mind when entering into a trade. These models may not always work. However, if you combine them with other forms of analysis, like key levels, it can become stronger. you will have to prioritize higher time frames. Any time frame greater than 1 hour is better. This is because of candlestick patterns, usually less effective on lower time frames. So the first step of the strategy is to define a key level on a chart. There are many ways to determine, like support and resistance, dynamic lock level trend lines, Fibonacci levels, and more. Here is an example in this chart. We can see that the price has formed a downtrend and reversed twice in a particular area. Make it a support level. Now have determined key level. The next step is to wait. Let price interact with it again. At this third touch, we are expecting the price to rise again. But we will need more confirmation from a supporting candlestick pattern. Uptrend. In this example, we see a big red candle, followed by a smaller red candle, and then a big green candle. Close above the first candle body. If you remember from the learned patterns, this fits the characteristics of a bullish pattern. 3 bars reversal pattern suggests that prices may reverse to the upside. You can place a buy order at the top of the third candle. Place stop loss at the low of the second candle. And set profit target. Double the expected loss. As you can see, after placing the order, price has increased to reach profit target. Here is another example in this chart. Prices are trending down, and it formed a support level turned into resistance. This happens because the initial price formed a support level, and price rejected it once. But then the price fell below that level, and now approaching it again from below. Make this an area of resistance. However, also see that price makes lower highs. Create a strong trend line. This area, where trend line and resistance level intersect, called the degree of confluence. Area where several major levels meet. Price is more likely to reverse at confluence. Currently, we wait for price to reach this confluence level. Once it happens, we predict a reversal. But we still need confirmation. Look closely and you will see 3 green candles. Each candle gets smaller in size, followed by a large red candle. This sample shows that when price approaches confluence, buying pressure is easing. Create opportunities for sellers to participate. This is the feature of a contraction candlestick pattern that reinforces expect price to reverse down. From this level, this setup provides a good opportunity to enter a short position. Later, you can place a stop loss order above the high of the previous candle. Place stop loss and double take profit, double stop loss. As you can see, the price has dropped and achieve profit target immediately after joining. Leave a comment below if this video was helpful to you. And don't forget to like and subscribe to the StocksCK channel. Thanks for watching. See you in the next video.